Hi friends, good day. Today, let us try to understand about what is bull market, what are the types of bull market, what is bear market, and what are the types of bear market, how to recognize bear market, and how to recognize bull market through this video. According to Mark Douglas, if you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. Before we go in,
Please subscribe for more videos. Click the bell icon for updates.
in the investing world, the terms bull and bear are more frequently used in order to describe the market conditions. These terms give us an idea on how the stock markets are doing, that is the general picture of whether they are appreciating or depreciating in their value. As an investor, the direction of the market is an important driving force that has an impact on your portfolio. So it is important to understand these market conditions and how each of these market conditions may have effect on your investments. Bull market. The term bull market is used to represent the market condition when the prices are rising or are expected to rise. The price rise is of the stock prices of various securities in the market, mainly equity instruments. There should be a growth of 20% or more over a sustained period of time by several stock exchanges in terms of trade volume and purchases in order for the market conditions to be categorized as bull market. This specific term is used to refer the stock market but can be applied and used for anything that is traded, such as bonds, real estate, currencies, and commodities. Bull market tend to last for months or even years. Let's look into the types of bull market. Stocks. The three major stock market indices are Dow Jones Industrial Average, the S&P 500, and the Nasdaq. The causes that drive the stock to bull market are: Number 1. Top-line revenue. This should increase for the companies as fast as the economy grows as measured by the nominal GDP. This mirrors the demand for goods and services from consumers. Number 2. Profit. This is how much top revenue has been generated profit for a company. Number 3. PE ratio. It is the ratio of the stock price for each dollar of earnings per share. As the earnings begins to drop, the PE rises, which causes the investors to begin selling their holdings. Secular bull market. This market typically lasts a long time, between 5 to 25 years. In this market corrections where the prices decline by 10% but increases again are called primary market trends. Bond bull market. Bond bull market happens when the rates of returns for the bonds are positive for a long period of time. Gold bull market. This market is when the gold prices continues increasing. Market bull. A market bull is someone who thinks that the prices are going to rise. That person is called bullish. The opposite of this is the bear market, where the person is called to be bearish. Let's look into bear market. Bear market is the opposite of the bull market. A bear market occurs when the market experiences decline in the prices of the investments by 20% from its high. This may happen amid the negative sentiment if the investor and widely spread pessimism. In stocks, bear market is measured by an index like the Dow, the S&P 500, or the Nasdaq Composite. In bonds, a bear market can occur in treasuries, municipal bonds, or corporate bonds. Bear market also happens in the currencies, gold, and commodities market. These are all considered to be in bear market only when they experience a decline of 20% or more over a sustained period of time, which is typically 2 months or more. They can also accompany general economic downturn such as recession. What are the types of bear market? Secular. This market lasts from 10 to 20 years and is recognized by the below average returns on a sustained regular basis. There may be rallies within this period, which means raise of the prices for a period, but they are not sustained for a longer period and the prices revert back to lower levels. Cyclical bear market. A cyclical bear market refers to the one that lasts for a few months to few years. This arises due to business cycle fluctuations in an economy which usually occurs over 7 to 10 years. A cyclical downtrend in the stock prices is a common occurrence in a country, where the falling stock prices adjust automatically in a couple of months to regain a positive outlook regarding investments in the stock market. How to recognize a bullish market? Bullish trends can be identified with the following parameters. Market rally. Any sustained movement in the market price in any direction is termed as market rally. This may take place due to the demand side policies such as low interest rates, extensive tax rate cuts, etc. The increase in the income level leads to the sufficient funding available for the investments in the stock market, thereby increasing the stock prices due to the higher speculative demand. Volatility index. It is also known as the fear index. This is the major indicator of the bull market. It is a measure of the market volatility. It gauges the amount by which an underlying index is expected to fluctuate over the next 30 days. The volatility of the Indian stock market is indicated by the Nifty index option prices, which mirrors the sensitivity of all securities listed on the NSE. Generally, a high volatile index indicates that the investor fear has increased. In a stable market, the index is generally below 10. MCAP to GDP ratio. This estimates whether the markets have bottomed out or not. It is often believed as a thumb of rule that when a market capitalization to gross domestic product ratio moves above 1, the equity market starts getting attractively valued. Daily moving average. It is an analysis tool and another parameter to look at. In a bull market, the index will be above its 200 simple moving average and the stock value will be above its 200 daily moving average. How to recognize the bear market? The signs below indicate the start of a bear market. Number 1. Bear market typically begin before the economy starts to decline. Number 2. When the interest rates are rising. Number 3. Industrial production is starting to fall. Number 4. The weekly chart of the S&P 500 shows lower highs and lower lows. Number 5. The moving average convergence divergence line is below the trigger line and falling. Bear markets are sometimes accompanied by recession, which is the period when the economy stops growing and instead contracts, leading to the high unemployed rates. Well, thank you so much for watching. Please like this video and do share.